Assume on day 1, investment managers invest 40 crore in shares of Future Biotech and 60 crore in Elixir Biotech. It buys Future Biotech shares at an average price of Rs 1,000, while Elixir is bought for 2,000 per share. Thus, the fund has bought 4 lakh shares of Future Biotech and 3 lakh shares of Elixir Biotech. Assume that both these share prices remain at 1,000 and 2,000 respectively at end of the trading day. What do you think will be the portfolio value of the fund at the end of the first day? Well, it will be 1,000 multiplied by 4 lakhs plus 2,000 multiplied by 3 lakh is equal to 100 crore. What will be the value of each unit at the end of the day? Well, we have 10 crore units and hence 100 crore of portfolio value will be divided equally amongst them. Dividing 100 crore by total number of units, which is 10 crore, means value of each unit will be 10. This is same as when we started off. It stayed the same because share prices of both the companies remained same as the price at which we had invested. Hence, there is neither profit or loss incurred by the fund on day 1. This value of units is called the fund's net asset value or NAV. We can say the NAV is Rs 10 at the end of day 1. Hope everything is clear till this stage. Rewind the video and go back if you missed anything. Okay, let's move forward. Assume that the next day Future Biotech share prices rises to 1,020 and that of Elixir rises to 2,100. These are the end of day prices of these shares. Assume that the fund has done no new transactions today. Can you work out the NAV of the scheme at the end of the day 2? Pause the video here and do this simple calculation. Well, the portfolio value at the end of the day 2 will be 4 lakhs multiplied by 1020 is equal to 40.80 crore, which would be the value of future shares held by the fund, plus 3 lakhs multiplied by 2,100 is equal to 63 crores. This is the value of Elixir shares held by the fund. Thus, total value of the investment portfolio is 103.80 crore. This value is equally divided amongst 10 crore units and hence the NAV would be 103.80 crore divided by 10 crore is equal to Rs 10.38. This would be the fund NAV at the end of day 2. Isn't it easy and very straightforward? Let's make life a bit more complex. Given that this is an open-ended scheme, assume that it receives another 10 crore of investment on day 2 from investor E. How many units of the funds would investor E get? What will be the value of each unit? We know that value of each unit is 10.38. Hence, the number of units awarded to investor E will be 10 crore divided by 10.38 equal to 96,33,911.3680 units. The number of units need not be a whole number. Most mutual fund would go up to 3 to 4 decimal places in working out number of such units. The MF will create these additional units to be issued to investor E. At the end of this investment, the total number of outstanding units issued under this scheme will go up by this number and hence the total number will be 10 crore 96,33,911.3680. What would be our NAV post-investment? it still will be 10.38. This is how investments in any open-ended mutual fund works. Fund's portfolio will have 103.8 crore in form of shares and 10 crore in form of cash. Total value will be 113.80. If you divided this number by the total number of units, it will be equal to 10.38. Let's move on to the next day and say the price of future biotech falls to 1,000. The fund manager decides to invest new 10 crore that came from investor E into this stock. This would result in purchase of additional 1 lakh shares, and hence total shares in future biotech would go to 5 lakhs. Let's say that day ended with future biotech at 1,000 and Elixir at 2,050. The total value of the portfolio at closing will be 111.5 crore. The NAV will be this value divided by the total number of units. Thus, the new NAV will be 10.1702. Let's say that at the end of the third day, investor D decides to redeem 1 crore units out of 4 crore units he is holding. Value of each unit today is 10.1702. Thus, investor D will get 1 crore multiplied by 10.1702, or about 10 crore 17 lakhs. This represents realized profit of 17.02 lakhs. He had bought each unit for 10 and selling it for 10.1702, and hence he has made 0.1702 per unit, and that multiplied by 1 crore will give us the value of the realized profit. His other 3 crore units are also making profit, as he had bought them at 10 and current value is 10.1702. He could say that his unrealized profit in these 3 crore units is 3 crore multiplied by 10.1702 minus 10, equal to 51.06 lakhs. This is also called mark-to-market profit. We have not realized this profit, but we could have if we would have sold these 3 crore units today. Next day, the fund will need to pay investor D 10.1702 crore. All the money it had were already invested in these 2 stocks. Hence, the fund manager will have to sell some of the shares held to meet this redemption demand. Let's say the share prices are 1,050 and 2,100 respectively for 2 stocks, and the manager decides to sell 1 lakh shares of future biotech. That will result in cash inflow of 10 crore 50 lakhs. 10.1702 crore will be paid out to investor D, and rest of it, approximately 33 lakhs, the fund may decide to hold in cash and will deploy in the market in the next few days based on the opportunity in the biotech sector. The NAV at the end of the day will be the value of 4 lakh future biotech shares at 1,050 plus 3 lakhs of Elixir shares at 2,100 and the remaining cash of around 33 lakhs. Of course, we are assuming that closing prices of shares are same as these. It is possible that the fund would invest these 33 lakhs in very short-term deposit and earn some interest, as one would not want to keep funds idle. The total outstanding units have fallen due to redemption and is gone down by 1 crore. Thus, the NAV will be the portfolio value divided by the remaining units, and this works out to 10.5717. This is how mutual funds work, and their NAVs are computed. At the end of this exercise, you should have a clear idea about how the funds work and how NAV is calculated. The profit or loss made by each investor would depend upon the NAV at which it bought the units and NAV at which it sold it. For instance, if investor E were to decide to sell his units at the end of day 3, then it would have resulted in a loss as it bought the units at an NAV of 10.38 but would have sold it at 10.1702. Investor D made money because the investment was made at an NAV of 10 and redemption was at 10.1702. We will just add one more thing here, and that is the cost of managing the investment. This is the management fees. This charge is applied on everyday basis and it is taken out of the portfolio value. This fee would reduce the NAV and hence take it away from the profit of the investor or make losses slightly larger if one were losing money. Let's say that the fee is 2% per annum. It is applied on the portfolio value. Let's say P is the portfolio value at the end of the day, then the fees would be P multiplied by 2% multiplied by 1 upon 365. 1 divided by 365 is used as it is calculated daily while 2% is on per annum basis. If you were to factor this in, say in the last day's calculation, then it would work out to about 57,700. The net portfolio value will fall by this fee amount and hence the new NAV will be 10.5711. This is fall of 0.0006 per unit. If you multiply this with the outstanding units, then it should be equal to the fee amount, and that is what we see here. This completes our discussion on NAV calculations. With this understanding, we can discuss many more things about mutual funds. Hope you are enjoying the ride.